Hey, good morning, everyone. Marty Missouri here, Friday, the 4th of February, 2022, with your weekly macro update. Just going to stick with the macro today. We won't get into the technicals on any markets. We've done that a lot lately. More of that to come, of course. So today we'll just look at the big picture, general conditions. Our index in front of you broke even, stayed at 31.25. Actually had a lot of movement, but essentially it all balanced itself out. So kind of like markets, we're getting a lot of mixed signals throughout the economy, still notably above anything that we would consider recession risk. Certainly the growth rate of the economy does seem to be slowing, while inflation continues to be growing. Okay, so the charts that I have dialed up for you, the auto sales actually had a nice improvement that was higher than expectations, coming off of a pretty low level, still considerably lower than we were a year ago, but it was enough of an improvement to go from negative to neutral in our scoring. Mortgage purchase applications actually got a nice bounce here as well. 30-year mortgage rates continue to climb. The average is now at 3.78%, and clearly we've got people kind of rushing to grab these still historically low rates. We actually saw an increase in refinances, which you typically don't see when interest rates are rising. But if you look across the consumer sentiment surveys and the business sentiment surveys, inflation is something that's expected to last for a while going forward. And if that's the case, then folks are thinking, maybe we better lock those rates right now. So we saw an increase in our mortgage purchases apps chart. Non-farm payroll grew by 467,000, a lot better than what was anticipated. Unemployment rate rose a tick to 4%, but that's because of the labor force participation rate rose. So people coming in off the sidelines now saying, yeah, they'd be willing to work. Our average hourly earnings up 5.7% year over year, 0.7% month over month. That's a nice increase, still not keeping pace with the rate of inflation, however. The quits rate is still historically high, so that actually is bullish about the employment picture. If folks are willing to quit their jobs, they don't do that unless they have something better in the offing. Huge number of job openings in the job openings and labor turnover report, still call it 11 million. The labor force participation rate, as I mentioned, ticked up a bit to 62.2%. U6 unemployment, which includes what we'll call discouraged workers, actually is sitting slightly lower at 7.10%. So folks, there's nothing about these employment numbers that would cause anybody to worry about the state of the economy. In fact, what it would cause is people to worry about how aggressive the Fed may need to be going forward to try to get in front of inflation. If you missed it, read my morning note because I offered up some commentary in there on that as well. And this is all notwithstanding ADP's private payroll report Wednesday that said we lost 300,000 jobs. I wrote about that this week as well, so I won't belabor that here because we've already kind of tackled that on the written blog. The all-important Institute for Supply Management Purchasing Managers Indices, really kind of rolling over here. Services down to 59.9, manufacturing down to 57.6. I'm still scoring them positive. These are still comfortably above what is considered recessionary conditions in terms of the attitudes from these surveys. Just huge issues around prices going up, bottlenecks, lack of qualified labor, all these things have got them, as it relates to the scoring of many of their components, losing confidence, however, just in the overall state of conditions and their anticipation of business going forward, still comfortably expansionary. And when you read through those surveys, I featured some detail from the manufacturing survey this week on the written blog. What you read is inflationary pressures not going away, at least as we sit here today. Heavy truck sales, an often overlooked, I think, important economic indicator, saw a really nice bump here month over month, so that scored positive on our macro index. However, speaking of transportation, rail traffic continues to roll over, carloads and then intermodal transportation. And you can look back here where this data goes back on intermodal, through the last couple of recessions. And so, you want to pay attention to rail traffic as it's rolling over. Of course, lots of, we'll call it idiosyncratic factors playing themselves out in today's economy that are impacting things and showing us a lot of mixed signals. We can just put it that way. Once again, the economic surprise index, it got a little deeper into the red week over week, 4.60%. Moves daily, so this comes off of where we were last week. And then globally, still nicely positive in the areas that we track, but you see a real flattening out here. And remember, what this basically denotes is not recessionary conditions because it's below zero. It is economic data as it comes out relative to what economists had previously anticipated. The Bloomberg Commodity Index continues to break above that what would have been resistance here, and that's that peak from last fall. So yeah, the commodities trade looks very strong to us, very robust. We do expect lots of volatility. We'll show that in charts to come. Long term, we're bullish commodities right here. And then last but not least, the sector to S&P 500 ratios. This gives us a feel for market signals about the economy. This is neutral right now for us. Tech, as you can see, is underperforming the S&P 500 of late. Had a nice rebound here and then been rolling over a little bit. Facebook, of course, had a big impact on that here this week. As for the financial sector, a nice big move on a relative basis above what we're seeing in the S&P 500. And, that would be positive in terms of what it says about the economy. Consumer discretionary stocks. Today's big ramp would be Amazon, showing good numbers last night, and then the market rewarding that stock today. Still on a 1 month basis, still way below the overall results for the S&P 500. Materials sector underperforming as well today. Materials are taking quite a hit. Right now the S&P is actually up nicely, but lots of the sectors, including materials are down 1.2%. Industrials are down, staples are down, and so forth. It'll be interesting to see how we go into the weekend when this session's over. Energy stocks hugely outperforming the S&P so far this year. West Texas Intermediate yesterday pushed above $90 a barrel. Very interesting dynamics around energy all over the world, and that's a place that we'll get into the weeds deeply, I suspect, over the next few days and weeks. Industrials underperforming, having a rough go of it, as I just mentioned today, underperformed the S&P overall over the last month. And then we get to the defensive sectors. Consumer staples outperforming the S&P so far this year. Utilities outperforming so far this year. And then healthcare outperforming so far this year. So folks, all in all, what we have here is a very mixed picture for the overall setup relative to general conditions. And for our purposes here today, we're just showing you that picture as it relates to our general conditions index. Within the financial markets, and I just gave you a taste of that in terms of U.S. sectors, but really in the credit markets, we're seeing some signals that we're having to pay very close attention to. Across sovereign debt and the complexion, if you will, of sovereign debt, we're seeing things that we haven't seen in quite some time, particularly in the Eurozone, as we speak, relative to this week's European Central Bank meeting. So while everybody seems to be focused on equity markets and earnings from big companies and so forth, underneath that, there are some interesting, if not concerning, signals that are coming from the credit markets that have real-world implications for global equities as well. So something to keep our eye on. We are very glad that we're very diversified right here and actively hedging with options. We think that is key given the underlying risk that we see here and going forward for the foreseeable future. Folks, thank you as always for watching and listening. Hope you all have a wonderful weekend. Talk to you again soon. Bye-bye.